Hello, good morning everybody. My name is Heiko. Today is the 5th of February 2016 and we're going to talk about the non-farm payroll release today. It takes place at 2:30 this afternoon and Central European time, and we're going to analyze how the markets typically behave during this very important event. The non-farm payroll is released every first Friday. This is the normal case, every first Friday in a month. So it is an important event for the further direction of the markets. And sometimes non-farm payrolls, they initiate new trends. Sometimes they enforce existing trends. So it is indeed a very important number which comes out today. So I brought 4 different market types. The first market is the yield, which is basically the bond market, but keep in mind this is the yield and not the bond price. So if the yield goes up like this, the bond price goes down. If the yield goes down like this, the bond price goes up. That means if you want to profit from this, let's say this, or from this move, that means if you are expecting lower yields, then you have to buy the bond, because the bond and the yield, they display an inverse relationship. So the yield is here. We have the euro dollar here, we have the gold price here in the right corner, and we have the S&P 500 here in the left corner. So let's start with the S&P 500, which is obviously the biggest stock market in the world. And you see those blue arrows and you see those white arrows, and sometimes you see this red line, or here you see it better, the red line, dashed red line, and sometimes you see this blue line. And what does it mean? It means that you buy on this day, you sell on this day, and if the line is red like this, you see it is unfortunately a loser. And how is the rule for this strategy, if you want? So what we're going to do is we are checking out how the markets typically behave around those days. So that the rule is that we buy, you can see it here better, I'll show you the date. We buy here on the 3rd day of February, which is 2 days prior to non-farm payrolls, and we sell the day after non-farm payrolls at the open. That means we sell next Monday. This is the rule, and so it's very easy, buying 2 days before and selling 1 day after release of the non-farm payrolls. So what happened if we would have bought the S&P in the last months, in the last years, with this very easy strategy? So you can see it here, the S&P. We'll enlarge it a little bit. The S&P by and large went up, but look at this line. This is a virtual portfolio line. This is how your portfolio would have behaved if you would have followed the rule. But you see that the bias for the S&P 500 is more or less bullish. So it is more or less, we can more or less expect that the S&P is going up the next 1 or 2 days. However, keep in mind that starting from May 2015, this edge, this bullish edge, has diminished or even decreased. So I wouldn't be too confident today that the S&P will go up, because of the last equity peak. This is the highest point in your portfolio curve. It took place in May 2015, which is 8 months ago, and we are going down here, and so I wouldn't bet too much on an advancing S&P as of today. So this edge diminished a little bit. Let's have a look at the euro dollar, which is obviously the biggest pair in the world, and which is obviously, if we want to talk about the dollar, the biggest part of the dollar basket, if we consider also the pound and the yen and the Swedish krona and the Canadian dollar and the Swiss franc, but this is the biggest part of this dollar basket. And what we see here is the same rule. We applied the same rule, and what we see here in terms of the portfolio, in terms of the performance, is that the euro is typically to go down. So normally the euro has a bearish bias, has more or less a bearish bias. That you see that this curve is declining. So, and as we have bought the euro on those days I mentioned before, that means that the euro is prone to go down. I try to make a little bit more years here, that we have a more representative chart here. And but you see, we had times when the euro was supposed to get up, but these times ended 2014, and then the bad times for the euro came, and now we are again in a rather declining market during those non-farm payroll numbers, and especially if we take into consideration the big move of the euro in the last days, we are overbought now, as you see here in this indicator. The last time we were this overbought, it was here. It was also close to a non-farm payroll, and before that we've been here overbought, and before that we've been here overbought. It was not the top, but it was close to the top, and as well here. So from a technical point of view, it is more likely that the euro is supposed to go down further today when the payroll comes in, the payroll number. Let's have a look at the gold market. Gold had a good move the last couple of weeks. We are back in the 1150 area, and what you see here is the gold market with these arrows, which show the non-farm payroll day. So again, what we see here is we buy the gold price 2 days prior non-farm payrolls, and we sell it 1 day after non-farm payrolls, and it looks like this. You see here we had good times, we had bad times, good times, bad times. Sometimes it's like this, sometimes it's like that. So it's so-so. The edge in my mind, it's not, you cannot grab the edge, it's not too strong, it's more or less random what we see here. So for me there's no advice for the gold market, except that you shouldn't play the gold market today, as there is no real bias visible during this time. Next chart is more interesting. It is the yield. Again, the yield goes down and the bonds go up. The yield goes up like this and the bonds go down. So if you want to profit from this strategy, which looks like this, you should, if this should go up, you should sell the bond market. So as a short sell for the bond market. And here we see a clear, in my mind, a very clear typical seasonal edge around this event, the non-farm payroll day, which is that the yield is supposed to go up whenever we buy these. This is the yield. We buy the yield, and this performance goes up. That means that if we would sell the bond market to profit from a rising yield, then we would realize kind of this performance or equity curve. So this is what we have here in place. This is the most significant market for today in my mind. To summarize it, we have in general a bullish bias for the stock market. However, the stock market did not very good starting from May last year during non-farm payrolls. So it is risky, definitely, to trade the stock market from the long side. The next is the euro. This euro is so-so in this environment, but more or less a bearish environment. And on top of that, the euro is in an oversold condition. So if I would bet maybe the short side, or maybe if the euro spikes above 112, something like that, to play the short side is interesting. The gold market is so-so. I wouldn't play the gold market for today, because there is no real edge around this non-farm payroll release day. And the fourth market is the yield, the bond market, and the bond market is supposed to go down during this non-farm payroll release. Therefore, the short side is advisable if you want. So that's it. Trading around the non-farm payrolls day. Have fun, have luck, and good trading. See you next week.